The views expressed on the following program are not necessarily those of this station, its owners, staff, or management. The following program is sponsored by Citizens Financial Security. In a world where information is power, the original Money Doctor inspires you to rise above it all and plan ahead with guaranteed success. What if you knew ahead of time, before all the previous financial meltdowns changed the planet? If you had known these calamities were coming, what would you do? How would you change your lifestyle? Today's the first day of the rest of your life. So sit back and relax if you can and enjoy the next hour of information that will revolutionize your thinking. William F. Richardson is the original Money Doctor.
This is William Richardson with the American Dream and Principle of the Day. Today we're going to be talking about a founding principle that every structure of asset management class needs to have on the family setting and also on the corporate setting that protects the interest of the shareholders, which is life insurance. Now on the surface, you would think, okay, well, everyone has what they need and it's not something that we need to talk about. But actually we do. So we're going to spend some time talking about this. Now, if you look at it, it's really easy to say that most families of the American population, your average American family, is really underinsured on the life insurance, probably underinsured on the property and casualty, for the auto insurance for liability, but only going to focus on the life insurance. Those other aspects can get together when you're talking to your advisor and just going over really where you're at and something you should do on a yearly basis if you haven't done it in a while. So looking at your life insurance, typically for your average worker, that comes from the employer, and it's typically several years of their salary, and that's what they have. So, they may have $150,000, maybe they have as much as $500,000, and it was given to them basically from the employer. Most of them are not paying anything for that, and there was no qualifications for it. Now what happens is when you move to another employer, you'll go into a new employer and you won't have to qualify for it. But if you leave that status and start your own business, or you want additional insurance outside of what the insurance company is giving to you because you realize, gee, if I pass away, that $250,000 policy is not going to cover the home. It's not going to cover the college education. It's not going to take care of my spouse for 30 years in retirement or longer, especially if it's the female spouse, because women do live longer than men do, anywhere from 5 to 10 years longer. Now you say, well, 5 years, that's not a very long time. Well, those last 5 years can be very costly as far as health and putting money back into health, particularly if you did not take care of yourself in the younger years of what you needed to do. And so what does a life insurance company do? They value risk, and they take money in pools, and based on risk levels, they decide how much money you actually need to pay them in case you passed away during that time frame. And it's based off of your lifestyle, off of your health, off of things that you do. So if you have a risky lifestyle, you're going to pay more. If you decide to smoke and drink and have a different type of lifestyle that they think is going to be at a higher risk, you're going to pay more. And if something happens to you and you're rated with cancer, most likely you're not going to get insurance at all. So what we like to do is, when do you want to get insurance? As soon as possible, when you qualify for it. How much do you want to get? As much as they'll give you. Really? So I want to get more than I actually need today? If they'll give it to you, absolutely. And how do they base what they're going to give to you? The easiest thing is based off of income. So if I can qualify someone in their 30s and look out at their income over the next 30 years and say, great, we can get you, $1.5, $2 million We really want to do that, even though the liability is not currently there for that. Could be married, could be newly married. There's not a house, maybe there's not kids. But what happens 10 years down the road when that individual goes into the doctor and finds out that he has cancer? No more insurance. So whatever he has, he has. So really what you want to do is, take a look at what you have. Is it 150, 250, 500? Is it term? Do you have to requalify every year, 5 years, 10 years, 20 years? What's going to happen when you have to requalify again? Is it going to be very expensive? Will you be able to handle it? Or do you want to look at more of a permanent situation to make sure that your insurance is always going to be there, that you can tie that into our standard program of putting 10% away and allowing that money to grow? Do you want to do that? So that's where we need to look at what you're trying to accomplish. And typically, life insurance is a very dry subject. It's generally, well, let's change the channel. Don't want to listen to that. But you really do need to listen to it, because it's the founding principle of the basis of your house. So if you are sitting there and typically saying, okay, I'm not going to pass away in my 30s. I'm not going to pass away in my 40s. I'm going to make it until my 80s, and that's not going to be an issue. And it's really a waste of money. I don't need to pay all that money out every single month to a source that I'm not using. So you pay for your auto insurance. You pay for your homeowner's insurance, kind of because you're forced to do it. You pay for currently health insurance, and you're kind of forced to do that. But no one's forcing you to pay for life insurance. It's a thing that is on your own. And typically you're seeing that as a liability. It's a cost. You're trying to get the largest amount of insurance for the smallest amount of money, and hedge your bet that you're never going to use it, so you don't want to put a lot of money into it. But if you look at it a different way, is there a way that I can use the insurance company, use the tax code, and use my funding to get my life insurance for free, and at the same time build a large amount of cash that I can use to fund my activities? I can use to fund my college for kids, that I can use to fund purchasing my first house, purchasing a business, having an income stream come in for the next 20, 30, or maybe even 40 years. So we're living a lot longer these days, and we really have to balance our lifestyle. We need to balance everything that we're doing, where we're looking at our family, our work, our spiritual life. And in that, we need to see, what's going to happen to our family tomorrow if I got hit by a truck, right? What are you going to do? Where's your family going to be at if something happened to you tomorrow? It's nothing we want to think about, but it's something we have to plan for it. And most people spend more time actually planning out a vacation, planning out an activity, a project, than they do their long-term retirement goals, because it's not something we want to look at and say, okay, what's going to happen when I do pass away? Do you have a trust set up? Who's going to take care of your kids? What if you and your wife went at the same time? And typically, the man is saying, hey, I'm going to go first. So there's a bunch of insurance on the husband and very little on the wife. And we don't look at how much money it actually takes to replace the spouse in the house of all the activities, that they do. And if there's young kids, who's going to take care of that? So that could be $2,000 or $3,000 a month going out. Do you have that protection on the spouse side? Most people don't. So it's not just looking at the husband. You need to look at the spouse, the children, college education, everything at one time, with in mind of what do we look at typically, and what we're focused on about true wealth. If you've been listening to me for a while, you understand that true wealth is not money. It's not about cash. It's about family. It's about doing what's right. And when you're looking at that, we look at the very far out. So we look back out to we're 80, 90, maybe we live to 100. What are we doing today, to get there? And how do we protect that environment? How do we protect our kids, and not just giving them a bunch of money? Because what happens if you give someone a bunch of money? In 2 or 3 years, they're going to be broke. So you need to have the financial structure set in there. Work with an attorney and an asset advisor and a coach, a quarterback. Maybe you need a corporation. Maybe you need a trust involved there. All this is on an individual basis and needs to be set up. And the main thing you want to do is make sure that you are not paying too much taxes. Okay? So with that said, make sure you have the proper life insurance, you're working with your advisor, and until we meet again, keep your money safe. Living with purpose and real intent. If you're as concerned as I am, and you're not the type to sit around and wait for something to happen, there's something you can do. A special gift invitation. How to get growth, protection, and income for your money. Send a request for a special promo code to watch this new online video training series absolutely free in the comfort of your home or office. You will learn how hard-working American families protect and control their retirement money and never expose it to stock market risk or massive taxation. Watch this free video series and learn the rules. Send requests to info@citizensfinancialsecurity.com. That's info@citizensfinancialsecurity.com to view video online. Video series is shared as a public benefit for enlightenment.
As a financial strategist, William F. Richardson coaches college students, families, and businesses on income planning strategies. He focuses on how to create lifestyle benefits and retirement savings by following simple rules and proven concepts to optimize assets, preserve capital, and minimize taxes. During the Great Recession, clients of Citizens Financial Security who followed these strategies didn't lose one penny of their savings or retirement money, while others lost 30 to 60% of their life savings as the market adjusted. Assuming you've chosen to follow these strategies, there would have been zero losses due to market volatility, and your financial goals would be on track. Your money would have been triple compounding, protected, and available tax-free for any reason. Visit us at the World Economic Report at moneydoctoradvisor.com and visit our corporate sponsor, citizensfinancialsecurity.com, or call 916-500-4905. That's 916-500-4905.